Okay, so welcome back. This is my market and trading outlook for the week starting February 7th, 2021. Now, I wanted to start by doing a review of my sort of overall market thesis for what may cause a market crash in 2021, really looking at the role of the 10-year Treasury yield and the US dollar index. What to look for in those two indicators, as well as how how those indicators work maybe a little bit more. So a clarification for what the US dollar index actually means. Basically, it compares the US dollar against a basket of currencies. The biggest currency that it compares against is let's see, the euro. So the euro makes up 50% or 58% of the basket. It also compares against currencies like the Japanese yen, the British pound, the Swedish krona, Swiss franc. And so when you're comparing or when you're looking at the dollar index, it's looking at how much is the dollar worth versus other currencies. Another way to put it is, or another way to look at the dollar index is when people want dollars or when the demand for dollars increases, then the dollar index should go up. If the supply decreases, the dollar index should go up. And likewise, if the dollar demand falls, if people are fleeing the dollar, then you would expect the dollar index to go down. Okay, jumping over to the 10-year yield, why I use it, what it means, and so on. So first off, the 10-year yield is the rate of return, the yearly rate of return paid by the government to investors who hold the 10-year note, the 10-year Treasury note. So this rate varies based on demand. Basically, there's auctions that sell off these 10-year yields, and people bid. I'm not sure how the auctions work exactly, but the result is that demand kind of dictates the 10-year, dictates the yield on these notes. So if demand is really high, then the yield tends to be lower because the government doesn't have to pay as much for people to hold these notes. Likewise, or conversely, if the demand is really low, then they do have to pay more for the notes. And treasury yields are considered a safe haven asset during times of economic uncertainty. So usually what you see is as market confidence is high, the 10-year yield goes up. As market confidence is low, or if there's a panic in the market, then the 10-year yield will sort of plummet as people rush into the treasury note. Okay, so what I want to do next is examine the charts of the SPY, the 10-year yield, and the dollar index to see if there's any patterns that we can pick up on the great financial crisis of the 2008 timeline, as well as the basically panic sell-off that happened in 2020. Now, I already did this for the panic sell-off last year in a video last week, but I want to touch on it again because I feel like as I continue to gain an understanding of how the system works, maybe I can present it in a way that is a little bit more clear. And this is for myself in the future, probably more so than anyone who's watching, but anyone who's viewing is welcome to chime or to, you know, to watch and gain from this. So let's turn off volume for now. This is a chart of the SPY, the SPY, and you can see going into the great financial crisis, we basically had a market that was churning up for really since 2003. So a good 5 or 6 year bull market, and it peaked up in October 2007. Now what's interesting is I've got events marked out here. The market was already showing signs of weakness by failing to make higher highs. You know, normally this would just be a correction and then we would go in and make a new higher high, like we did pretty much every time we saw a downtick since 2003. But this is the first time, you know, it looked like we're entering either extended correction or a recession. You can see right here we dropped 16% before this first event comes up. Now the first event, March in 2008, was the DXY bottom. So flipping over to the DXY, this is going to be okay. So you can see here, this was where that SPY top was in October, and the dollar index had been in sort of a downtrend for many years. So yeah, since 2006 it had been in a sort of an extended downturn. And right here, March 2008, this was the all-time low for the dollar index. So the dollar was worth the least relative to other countries that it ever has been. So flipping back over to the SPY, you can see that corresponds to sort of a local bottom on the SPY. And then the dollar index goes flat for a while until July of 2008. Now what happens in July? Basically we start to see a bigger downturn in the market. You can see a 15% correction in not too much time, and the market continues climbing down. Then let's see, I should probably mark this out as well on the SPY, July 16th, 2008. So this is when the dollar index made a turn, and instead of going flat, it started turning up. Then September 2008, September 15th, the Lehman Brothers collapsed, and that's when you start to see the SPY collapse. But leading up to that, we have the dollar index basically, you know, rocketing up. This is something that has not happened for a very long time. You know, you broke one trend, the downtrend was broken, and now the dollar index is going into an uptrend. And then the Lehman Brothers collapses and the market goes into a free fall. And what happens to the DXY? It also goes into a free fall for a little bit of time, and then it reverses and continues its uptrend. So this is telling me that suddenly people wanted out of the dollar at the beginning of this collapse, which is counterintuitive, because if you're leaving financial, you know, high risk assets like stocks and bonds, what are you fleeing to? You would think it was the dollars. So that's you know, that may be where bonds comes in, but you have this downturn. We'll come back to that in a bit. you have this downturn in the dollar, and then it reverses and moves up until November of 2008. Now, if you go back to the SPY, you can see this very sharp sell-off here. If we turn volume on for a second, high volume sell-off. This looks very bottomish. So I suspect people stepped in here to start purchasing, risk assets, expecting this to be a bottom. And so this corresponds with kind of a local top in the dollar. So after this, the dollar basically follows again, probably as people are going back into financial assets, at least for a bit. And then it turns around and goes back up as the stock market bottoms out for reals this time. Okay, so now we're looking at a chart of the 10-year yield. And you can see that not too much happens with this at the start of the financial crisis. Yields aren't plummeting until right about here, 18th of November 2008, which that's right about where the SPY bottomed out the first time, or where you saw that first bottoming pattern in the SPY. So right here. So why does it wait? Why does the 10-year yield have to wait until the market drops 40% to start buying up bonds? And I expect that this was when the Federal Reserve started to buy up, or started quantitative easing, meaning they're effectively purchasing treasury bonds. Okay, so just as I expected, on November 25th, 2008, very close to the time where 10-year yields started to make a free fall, this is what happened. The Federal Reserve press release announced the purchase of direct obligations of housing-related government-sponsored enterprises, Fannie Mae, Freddie Mac, and the Federal Home Loan Banks, and mortgage-backed securities backed by Fannie Mae, Freddie Mac, and Ginnie Mae. Purchases of up to $100 billion in GSE direct obligations under the program will be conducted with the Federal Reserve's primary deals through a series of competitive auctions and will begin next week. So purchases of up to $500 billion in mortgage-backed securities will be conducted by asset managers selected via a competitive process, with the goal of beginning these purchases before year end. Purchases of both direct obligation and MBSs are expected to take place over several quarters. So basically, the Federal Reserve was setting up to purchase different securities, and although it's not direct purchase of bonds, it did drive the prices of bonds up, which I find interesting. That's not quite what I expected. I expected direct purchases of bonds. So that's something probably to look at later, is why did the purchase of other assets, financial assets, drive bond prices up or yields down? There's something I'm not understanding here, and I think it's probably worth visiting later. But this is what the timeline looks like. Let's just go to the SPY to start with. Okay, well, 10-year yield works. So November 25th, 2008, quantitative easing was announced. They said they were going to begin it next month or next week, which, is right about here. And then, oh, sorry, this is still the DXY. Well, you can see the effect on the dollar is that it dropped the dollar valuation. On the SPY, well, basically the SPY rebounded for a little bit and then it dropped a bit more. So this wasn't the absolute bottom of the market back here, but it was pretty close. They were successful in turning the market around. Now, the 10-year yield, as soon as the Federal Reserve announced QE1, that's when, it already started before that, the sort of free fall. You can see if you call this a little trend line, we broke below the trend line and kind of went into a free fall on the 10-year yield, meaning prices were going up quite a bit. So I guess the question is, why was the 10-year yield pinned up for so long before all of this happened? The Lehman Brothers bankruptcy was right here, so you'd expect immediately a surge into treasury notes and yields to fall, but that didn't happen. Instead, yields actually began to rise. So yeah, to me this doesn't all add up. I don't have a comprehensive understanding of how these forces work together. Okay, so even if there isn't a full understanding of why some of these things are happening, why does the dollar index drop like crazy at the beginning of a crisis as people are fleeing into dollars, where you would think that as demand for dollars is rising, suddenly shouldn't the value of those dollars suddenly rise? Even that, if that is not understood here, I think there are some things that can be pulled out from this, patterns that are at least recognized. The first thing is, at the beginning of the collapse, the dollar drops like crazy, and then it basically rockets up. And then once the Fed steps in to do their quantitative easing, then the dollar drops again. That's what you see in 2008. What do you see in the most recent financial crisis? You have a rise in the dollar, a rejection, a sharp drop at the beginning of the sell-off, and then we have a sharp increase. And in this most recent crisis, the SPY bottom actually did coincide with the Fed's announcement of basically ramping quantitative easing up. And that's when the dollar did a quick reversal, went down, and basically began on a downtrend. And that downtrend in the 2008 crisis also happened. Let's go back. Yeah, basically as soon as the Fed's quantitative easing was announced, we went into a sharp downtrend. Now we did go back up again, but as quantitative easing progressed, the dollar continued in its downtrend. Now there probably is a little bit less to pull out from the US 10-year Treasury yield. All we can really pull out of this is that, well, as the market was collapsing, the 10-year yield was sort of fluctuating. Uh, the sort of more smooth movement that had existed before turned into a more mm, chaotic, volatile movement. Does that tell us anything? I don't really know. I don't think it is meaningful, but it's something to note. In the 2008, or sorry, the 2020 crisis, the bond was a little bit more exciting. Just after the SPY topped, the bond yield went into free fall, and it basically had a big bounce, topping off here as the SPY bottomed out, and then really it kind of went sideways in a volatile manner, and eventually now it's in a extended upturn. So there's not really much of an analog between the 10-year bonds price action, well, percentage action in 2008 to 2020. And I find that rather curious. Maybe it is partly because was a different mechanism for why that happened. I think that no, I'm not sure that there wasn't, well, this is what I do know, is that in 2008 there was more of a debt crisis where the debt market was collapsing. In 2020 there was no such event. This was a market panic sell-off, and so it makes sense that people maybe were fleeing into higher safety assets. But debt, money, currency was not collapsing. Debt is effectively currency in our MMT environment, and so if debt is not collapsing but people are still fleeing high risk assets, maybe this is one of the effects that occurs. So that probably isn't right, but it's a possible answer. It's something, that I need to look into more before I start saying I have any authority on what will happen or on how this mechanism works. All right, so another thing to take note of is that the 2020 crisis didn't start in 2020. There was a repo crisis, which I don't really understand. I haven't looked into that crisis very much, but by looking into and understanding the repo crisis, that may lead to an understanding of what happened in 2020. From what little I do understand, there was some cracks in the financial system, and this sort of market crash would have happened anyways, regardless of what happened with the virus. And so that is a piece of the puzzle to bring in. I think it makes sense to do some learning and studying on that to see if that's sort of the missing piece of the puzzle, why these two timelines for these two market crashes don't sort of line up in terms of the action or the chart action of the 10-year yield. All right, so I'm gonna go ahead and get into the market analysis for this week, as well as my stock picks. So let's go ahead and get into it right now. This is what we're seeing. I am bearish on the market this week. If one condition is met, and that is if the market closes tomorrow below this green trend line. Now this green trend line, you can see in the short term, has sort of a few reactions, creating a rising wedge, but it has reactions long term as well. So back here in November, and then again at the bottom in March. So that could be a valid trend line to watch out for where this closes. And I think it's important for the reason that we closed Friday basically right on that trend line. You can see short term, we had to, well, I guess, yeah, we started Friday on the trend line, closed effectively right below. I don't really see, I mean, this is all-time high, so it's not really an important level of support, although now it is. Now that we've closed above that, it's important. Before that, the only importance about that level was that it was where the trend line stood. So if we are able to break above that, then we continue bullish on this market until we see another breakdown signal. But for right now, what I see is we basically broke down above this or below this wedge, and then we're doing a retest of it. Now another way to look at it, this chart is absolute mess right now, so let me get rid of some of these lines and just keep what's more important. I guess really what's important is that we broke below this black line, which is kind of your longer term since 2008 trend line. Since 2008, it basically acted as close to support. I know this isn't greatly plotted out or greatly drawn. It could be drawn a little bit better, but this is roughly the area where we want to say, you know, above that we're bullish, below that we're bearish, at least when we're this close to that line. So we're above that. We briefly broke below, and then we broke out above. The other line to look at is maybe this pink line is our valid trend line now, and well, we briefly poked below that and then we recovered. If that's the case, then we're still pretty much bullish. So whatever way you look at it, I'd probably give it a 50-50 chance that the market will close red, or will we'll have a red week this week. What really I think is important to keep in mind, probably the most important signal here, is that we have short-term bullish divergence on the daily chart, and unless we burn through this by having a really nice green week next week, we're going to break down. And if you look at other indices like the QQQ, nothing's really wrong with this. We're kind of just barely made a new all-time high. If the market does turn down, though, we'll have negative divergence on the daily chart, and it'll basically be, I guess it will be short-term new negative divergence, long-term since the September area, which I'm not sure how valid it is to count that. Then it will be, you could say that's bearish if you use that as a metric, but I think we just have to wait and see for the QQQ. If we rise above this level on the RSI, then that indicator is sort of invalidated. IWM, it looks to me like we're in this narrow upward trend. We broke down below once but recovered, and now we broke down again and we're trying to recover, but what's important is we didn't recover on Friday, and so that could be a red flag for the market if you are a bull. Okay, so I guess the next thing I want to cover is the DXY and the IWM. Really, we were in this falling wedge on the DXY, and we broke above this falling wedge, and we're sort of we had a down day in the DXY on Friday, but I think this was a short-term correction for an upward trend that, depending on how fast we move up, I think this upward trend will ultimately take this to this 92.20 area. And so I wouldn't worry too much about the market if we go up to that area and bounce down and then continue our downtrend. However, if we break above, that's bullish. But I think we've risen enough in the dollar to where it may be time, just getting up to this 92.20 level may be enough for a little bit more of a correction than we had. That is my assumption. If we get up to that level and then break above and just go, skyrocket, then that's a big red flag for the market. I think we could see a market crash in that scenario. So that's what I'm looking at for the DXY. The 10-year yield. This is something where I am, so we're at a couple important levels. Let me turn this off. Logarithmic. Is it? Okay, so I drew this green line with log chart on. I don't know how valid that is. So let's just get rid of that. Let's just focus here at the fact that it's on kind of a critical level from back here in March. And we're in this kind of rising wedge pattern. If we get rejected here, then we have negative divergence on the RSI, and we may turn around and break below this. And if we break below this without rising much more, I think that's bullish for the market. Yields rising, yields slowly falling. That means interest rates are slowly going down. Debt is getting cheaper. However, if we see this thing break up and skyrocket, then that could be an ominous sign of the market and be sort of a sign of weakness. I think before the observation was that, well, let's just go back to what happened in the March crash. We basically saw a sudden free fall in the DXY, basically a breakout of trend and a sharp fall on the DXY. So the rising interest rates, I think it's sort of a leading indicator of danger to come in the market if it just keeps rising for a while. Again, I still don't fully understand how to use these indicators, so take what I say with a grain of salt. Just right now, I think if the dollar and this rise together, that could be ominous. And then if we suddenly see it, tank, break trend and tank, that probably means the market's already crashing. That's kind of how I read that. Okay, looking into gold. This is interesting because depending on how you look at it, we could be in two different sort of scenarios. One is we have this bull flag pattern and we broke out of it, and now we're just doing back tests. And normally one back test is all you really want for the bull trend to continue, and then you should see the breakout. Now that we've got two back tests, I don't like that. That could be, a sign, a bearish sign. So it could be just doing back tests until it breaks down, or maybe this longer term trend line, it doesn't look like it's good on the daily chart, but on the weekly chart, this isn't a confirmed trend line yet, but it might be if we kind of grind our way down, or suddenly drop and then bounce off this level, then that's a confirmed trend line and it's bullish for gold. So that may be what happens. Another scenario is this just breaks down, maybe we make our way back into the bull flag, break down, and then have our move up in gold. I think it's incredibly unlikely. Like, I would say it's unlikely enough to where I'm willing to go all in to bet against this. But I think it's incredibly unlikely that this is our top in gold. And there's a bunch of reasons for that. And I think I want to cover that a little bit more, probably in my next video, because it's something like the bullish thesis on gold. It doesn't just extend to gold and silver, it extends to all of the commodities. But the short term, or the short answer for why I don't think this is going to break down, is if you look at other times in history, like back here in the 80s, we reached $800 in gold, and what did we do? We broke above it, and then grinded sideways for a while, and we didn't break out for quite a while. Now, we didn't have like a false breakdown and breakout, but this is how many weeks? From March all the way until October or November. So basically 6 months it consolidated and then broke out and went higher. Another thing I wanted to note on stocks that are going up, just a fun little note for why the RSI isn't always valid, and that is this. Now, I'm not sure why most of this, it's because the log chart is back off. Okay, so yeah, this is actually a lot better. This chart wasn't really very well confirmed. I guess if you use this green line, then you could say this is a chart, but you can see in this bull flag we broke below any sort of level that we would consider support, or a trend line of support. It wasn't like confirmed that this was our trend line yet, but 2 reactions is better than nothing, I guess, is what I'm saying. Is it's a probable area of a probable trend line when there's only 2 reactions. It's more of a confirmed trend line when there's 3. But yeah, it looked pretty scary. I mean, we broke below this previous little peak and popped below for probably a couple days and then broke higher. That's when basically the bulls that did not have convictions in their trade and had their stop set down here, they got stopped out, and then the price action took off. These I guess the price action loves to do that. So I would not be surprised if we had another breakdown that ends up being a false breakdown, and as everyone is jumping out of the trade, a bunch of new buyers are jumping in, and it just takes off. So I would say, I'm gonna hold on to what I have in this metal, and I'll add more if it breaks down. That's my plan. Silver probably would help if I typed it right. Silver is a similar, I think, scenario, or my outlook for silver is similar, and it looks to me like well, actually it's probably more bullish because we had one, if you use this as the level that needs to be broken, or the upper trend level, this, then we had one false breakout, and now we had another breakout, but it's doing a back test. And so I would say in a couple of days, if this doesn't take off and it breaks down again, well, that's short-term bullish for silver, but long-term that's short-term bearish for silver, but long-term I'm in a position where I just want to buy the dips. And that goes even for a scenario where the market entirely crashes. I have a very hard time on this chart seeing a scenario where this silver crashes to below March lows. Or I mean, I would say if it even goes back to here, then this is a false initiation of a multi-year bull market in silver, because almost every way you look at it, let's say we look at it like this, there's a few reactions here, and I mean, you could sort of get maybe a funnel pattern out of this. You have something, maybe just put it here. That's one way to look at it. And I think this is like more of the commodity bull market way of looking at it, is that we're sort of consolidating for a long time, and yeah, something like that. I'm not going to take the time to find the perfect levels, but you can see, we basically have high volatility, and we've been consolidating into less volatility over, a multi-year period of time, and we broke out of that. So if this turns into a false breakout, well, first of all, I'll be scratching my head, because if the dollar becomes that much more valuable, that's incredible to me. Something in the world will have to turn upside down for this commodity to lose, or this metal to lose that much relative to the dollar. So yeah, I'm not really worried about a breakdown in this. If it becomes that valuable to hold cash, well, I'm sitting on enough cash to where that shouldn't be an issue. And back holding this stock for 10 years, or these stocks for 10 years, would probably not matter very much. But if we're right in this thesis, then, I mean, yeah, we're going to see really high prices. That said, I don't think I'm going to try and trade the mining stocks while silver is having this sort of price action. I think silver almost has to break away from basically break out of a position where it's controlled by the COMEX and the big banks, because right now really the market cap of silver and gold is so small that small little disturbances can do stuff like this, where we have this false breakout whipsaw effect where it goes up 10%, and then, well, how much did it go up? It went up 15, almost 20% in just a couple days, and then it was back down to where it started. And that level of volatility, especially with overnight ups and down gaps, that's really hard to trade. I think it would be a lot easier to trade if it didn't have the up and down gaps overnight all the time. So this is just another a longer term play that I'm going to be doing. Now, with that said, I want to point out a stock that I want to point out a stock that I'm really probably more bullish than most other stocks on, and that is this First Majestic Silver. And unfortunately, this thing had a breakout before I was expecting, and so me trying to basically trade this stock short term what happened. Basically, at this level, it had a false breakout, and I unloaded right here at around this 1190. And then 2 days later, or no, the very next day, it had basically moved up to make a breakout. So that was unfortunate, and that was sort of like the final straw that told me it's probably not a good idea to trade this metal, because it looked like it was moving towards, I mean, it looked like it was bouncing here and then breaking down. Now looking at it now, this price action seems more reasonable, but my expectation was it was going to continue going down, and I think that was foolish, because I've seen this before. The stock moves up and down between its range, in this sort of funnel pattern, and then at the last minute, or at the last leg or bounce on the top of the trend line, we don't have a full pullback to the bottom trend line, we just have a partial one. And then here in this case we had another bounce, which on the weekly chart it looks a lot cleaner, where that's kind of what you'd expect to happen. And at that point, if you're in the stock, you want to just stay in the stock. If not, you probably wait until a breakout happens to get in. But anyways, it looks like to me like you've got this long consolidation, which the if this pattern plays out, we're talking, I think it's something like 2,500%. Yeah, let's just say 2,000%, 20x gain over probably a couple of years on this stock. And so my play is going to be basically buy and hold until it looks like the bull run in gold and silver is over. But this is the I think the biggest silver, or the most pure silver miner out there, at least for its market cap. It's one of the bigger ones, but it's also like the most pure. And up until recently, it was like a really good buy because the short interest was pretty high, and especially back here around the $10 level, that was a good area to get in. Now it's like, well, maybe wait for a back test, and that's if the silver market is about to take off, that's probably the last opportunity that you'll have to get into this stock. If not, and this breaks down, which I kind of hope it does, so that there will be an opportunity to get in, probably around a $5 level. That would be the market crash scenario, happening sooner than expected. That would be the scenario in which probably you would get this at around $5. But maybe the market crashes, and only part of the market crashes. Maybe because so many people were shaken out of the market recently, only the higher market cap stocks, people only get pushed out of those, and this one only drops maybe 20-30%. This one and all the other miners, because most of the miners are pretty small market caps. I would be surprised if, well, nothing should be a surprise at this point. Okay, so that was enough of a ramble. Let's get into the stocks I am looking at playing this week. Now, there's a ton of stocks on my watch list. These are just almost random picks that seemed like good plays for this week. This is one of the bullish case stocks, where if this has a retest and the market, well, yeah, probably no matter, I expect a retest of this, but it's basically a funnel pattern that's played out, or has been playing out since October. It's broken out. If you can get in at a retest, that may be a good area to go long, and seeing something like a 50% gain on this stock. Now, I guess the risk is you get a retest, and say that retest comes when the market takes a downturn. Well, if the market takes a downturn, it's most likely that it's going to continue going down. This market is tricky, but is it so tricky that would have two false breakdowns in a row? Probably not. So my expectation would be that that if it does do a retest, it's not a great area, but it's something where I'll just wait and see. Maybe you get lucky and this does a retest without the rest of the market turning down, and it becomes a good trade entry opportunity. Okay, Upwork. Now this is a stock that has been looking fairly bearish. So if I think this may be a blow off top starting. So one thing I was looking at, why do some of these stocks have blow off tops and others do not? And I think part of the reason is short interest. This stock only has a 6% short interest, but that may be enough to where shorts get in here, the stock decides to jump up a little bit, stop people out of the shorts, and then this stock goes down. Because what I've noticed is some of these stocks, basically stay within trend and then break down and maybe retest trend, and then well, at this point in the market we're just at the retesting trend after the breakdown. But other stocks look like they're going to break down and then they have like a blow off top instead. So that's basically, if this has a really high volume day and doesn't move up very much more, that's probably a good area to enter short. The other area to enter short, it would be a break below this this level here. Amazon, this is another stock where probably at the beginning of the day, Friday or Thursday would have been the best, or even Wednesday would have been the best time to get in. But I think there's still a good enough risk to reward where you could just size your position down and get in for something like a 22% gain from the bottom. So 22% would bring us about $4,000. So let's say the $4,000 level. If you can get in at this area, that's still a good risk to reward ratio. So in the bull market case for next week, Amazon may be a good play. I'm not going to trade it because just the share size is so expensive that how much would I have to risk to get in one share? Around 10%, or well, about $100. So I don't think I'll get in this trade. I may change my mind, but right now I'm not planning on it. Barrick Gold. So this one is interesting because it's been in sort of a bull flag pattern or a downtrend, and then it finally broke out, and it has done one retest, two retests. So it may be good to go long here. If it does a third retest, maybe that's a little bit shaky. So I'm at it's at the point where I expect it to just break down and basically drop a lot, because this is, it's below a major support level, which is, I guess, this level in 2020. Below this, you've got a couple reactions here. Below this, we're looking at around 1970 or so. So it looks to me like this is having a false breakdown and it's going to slingshot up, especially because it hasn't broken below this trend level. So right now, I think it's probably still a good area to go long and see if it continues upward. If not, and it has a downturn again, I'd be probably second guessing the trade and having to reevaluate it. IAG, this is in a similar scenario, except for, well, yeah, it's in basically a similar position where it has broken out and now it's just sort of sitting at this upper support level. So I think right now would be a good area to go long on it and see if it resumes this breakout. This may be something where it breaks out a little, consolidates, and then actually has the explosive move up. Sandstorm or sand. This one isn't a trade yet, but you can see on the daily chart we are starting to get bullish divergence. It would be really, let me draw it here. It would be really right down here that you would see the bullish divergence, but it's just starting to get that, and so it may be a good time to start accumulating this stock if for a long-term hold, or be looking for the breakout for a shorter-term trade. Ruger, this is an interesting one. I don't think I'm going to trade it, but I'm going to watch it. But it has had this sort of bull flag pattern, but it had one false breakout and then another false breakout, and now it's having a third, what looks like a breakout and retest. So right now is a good position to get in for the trade, and I think it's a fairly bullish trade. I guess the issue is picking a profit target, because it looks to me like this has had 1-2 legs up, which, if this is our profit target, 11%, that's not great. But since the false breakouts were so much higher, profit target's probably going to be more like 33% or so, and I think that's what I have charted out here. No, I had it even higher. But even if it's even if it moves up to about $90, that's still a 6-to-1 risk to reward ratio. So pretty good, probably a good risk to reward trade, even if it has a lower probability of playing out. AMD. Now this is one that is interesting because it looks to me kind of like what like Barrick Gold looks like, where it's broken out, has had a consolidation period, broke down below a major level of support, and now it's just sort of sitting here deciding what to do next. So I guess if it does break below, probably at this point, the level of support I would want to see it break is down here. If it breaks below here, then I think it's a good short. Otherwise, that may be a long trade if it breaks out above this sort of consolidation area and move higher, or that would be a good breakout to the top of the trend channel and perhaps higher. Okay, ASML, this looks like it's setting up to be a short trade. Let's look at the short interest. Okay, so there's like no short interest, almost none. But what this does have is you're starting to get slight negative divergence. Not quite there yet. Well, it's kind of there. Yeah, you're getting it right here. So if this breaks down, it should be a good short trade, at least down to this level here, and then with a longer term profit target of down here. So this is something I've been watching, or I will be watching. It's been basically going straight up with no corrections, so I think it's a good short trade in the making. Baidu. Now this one has been interesting because there's sort of two trend lines here, or two trend channels. I'm not sure why this is drawn this way, but this is sort of the two trend channels that it's been traversing. It broke into a higher one and then it's been bouncing around, and then it broke down, and now it's doing a back test. So given that this has such significant negative divergence, I think right now is a good entry point for going short, down to probably a more significant level of support, probably around here. ESTK, this is another short trade. Basically negative divergence, kind of rising wedge pattern, broke down, it's running up for a back test. Now maybe good time to enter, or you could try and be a little bit more tight with that risk and make an entrance at the actual test of this trend line. Is this actually, I mean, this is a kind of confirmed trend line because you've got multiple reactions down here, but you don't have multiple major reactions. So you could probably move this down a little bit and say, well, it's basically retesting right now. In fact, I think that's more accurate. So right now would be a good entry, but probably it will gap down, and that's the thing for most of these trades. I kind of doubt that they're all going to open right where they're sitting, right where they're closed on Friday. So a lot of these trades may be nullified by the time Monday comes, but there's something to watch out for. GSHD, Goosehead. This trade, it looks like a short in the making. This has like 5% short float. So I think it has had one false breakdown. If it has another false breakdown, I would probably take that short, just because, I mean, it's making new highs, but it's still in that negative divergence that it's been in. It's still in the rising wedge. Nothing has changed with this just because it had a false breakdown. Macy's. Now this is an interesting one, and I do think this was short squeezed, and because it was set up for a short trade and it was so obvious, and there's probably a lot of short interest because this is a stock that's expected to fail. I think Macy's is one of those businesses that is less likely to make it in the current economic situation. But this had a 28 or almost a 29% short float. So that's a lot of shorts that would have probably gotten stopped out here. And if I would have looked at this before I entered the trade here, I think I may have avoided getting stopped out, here basically twice with this, what I assume is a short squeeze. So now I think the shorts are mostly out of the trade, and right now maybe a good time to enter again. I'm actually in this trade. I think I re-entered short on Friday. Net. This is a stock that's setting up for a short. It's got 6% short float, and it looks to me like it broke down and it's just doing a back test. So right now would be a good entry area for a short. Neo. This is one that has about 6 to 8 or 6.8% short float. So it may be something that you watch for a short squeeze on and then go short on after that happens. Or right now maybe an objective entry point to go short. The price or the charts on this, they're a little bit harder, or it's a little less clear. You can see there's two possible trends that it's been following. One is this with the purple line, and in that case we've been below the trend line for a while. The other one is this green level, or this green line, which you can see kind of has a reaction here, definitely has a reaction here, and has a reaction back here. In either of these scenarios, I think now is probably the time you want to be short on this. You can see it's got really significant negative divergence. So I may take this as a short trade if I have the opportunity before it drops. The only thing I'm hesitant about is that The first level of support is pretty close. So, I mean, it's a 28% drop. But where do you put your stop? Because this is a volatile stock. You know, you can see it can move against you 8% before it goes in your direction. So that's like around a 2-to-1 risk to reward ratio. If you take the short, at least for the first price target. Later on, you'll get probably reaction here, final price target probably way down here. I would be surprised if we got that low unless the entire market has a crash. WH, this is I think this is one that's setting up for a short. I don't think it's there yet. You can see we don't have the negative divergence yet, but we do have a decent ways to fall if this does break below trend before you get major support. So one to keep an eye out on. Zillow, I think I am in this trade short, but it's been, you know, a long rising wedge, and then we've finally broken down and are doing a back test. Now, let's see what the short float is, or short interest is. It's only 1%, so I don't think they're going to have a short squeeze on this. So right now would be the area to be short. If it falls a bunch, well, I wouldn't add to my position if it suddenly gapped down. Chewy. Now I thought this, okay, so this has about 19% short float, and we may have had a short squeeze right here. But you can see this has broken out a trend, and then it's broken below that new trend, and now maybe we're running up to do a back test. I really am not sure what this looks like. So I would say if it actually does a full back test of at least this one of these two levels, at the minimum I'd want a full back test of this lower trend line here, and that's where I would go short. Otherwise I would be watching out for a short squeeze with the high volume, and that's when I would go short. Okay. So cold, this looks like a long trade to me. It's been consolidating in this area for a long time, and it's breaking out. It had a breakout flag, kind of. I mean, not, it doesn't have too much volume, and then some consolidation for a back test, and now it looks like it's actually running a breakout. It's probably an okay area to enter right now, but I want to see some volume, some bullish volume. The thing is, when the bullish volume comes, it will already have been it will have already made a bunch of movement. And another possibility is maybe this isn't the right, actually, you know, I think this is more likely the levels you want to look at. So let's get rid of that for now. Something like this. So maybe it hasn't broken out and it's getting ready to. But once it does break out, I'd probably be looking for maybe a movement of 21%. I'm not exactly sure how to gauge for this stock in particular, just because its price action is so messy. But I've looked at maybe 20%, which would put you, you know, $44 level. GSS, this is another gold stock. It looks like it's breaking out right now. You know, it had one sort of fake out, breakout, and broke back into trend just a little bit, and now it looks like it's making another attempt at breaking out. The volume isn't there yet, but if you start to see impulsive volume, that's probably when to get in, or you could just front run the trade and hope it works out, because this is a high risk to reward ratio, even if you are wrong a few times in a row. When you finally do get the breakout right, it's probably going to move a lot in a day and not give a very good opportunity to get into the trade. Nike. So this had a nice breakdown, but it looks like it's running up to do a back test. And I think if it at least retests this level, that would be a good entry point. I'm probably looking for entry point at a retest of the trend line, because it's most likely to run into this level, move a little bit further, touch the trend line, and then fail and stop at this level at the close of day. That's at least what I would expect. Could be wrong, but most likely I'm wrong, but that's where I would enter the trade short. If it does a full recovery, obviously that's no longer a good trade, but right now I think something like that may happen. Lemonade, this has basically been setting up for a short, and then it broke out a trend, and now it's just been going sideways. The short float is actually 22% on this, so I wonder if this, I'm not sure, I'm using FinViz to see the short float. I'm not sure how far behind it is, but this may have been a short squeeze back here. Especially with this super high volume here. That may have been the short squeeze, and now we're just looking at breaking down and dropping. So I would probably enter this trade if we had an impulsive breakdown from this support level. Autodesk, this has been looking bearish, and then it had a breakdown, and now it's moving up. Now this broke back into trend, but if it breaks down again, I would be entering short. The short flow on Autodesk is pretty low. Okay, so those are all the stocks I'm looking at trading this week. And I guess we'll see how it goes. Anyways, have a good evening and week.